think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, we are back in the building with Benjamin from the ROI channel, Return on Your Investment. So I don't know if you all recall, but me and Benjamin, we were on a live stream one day, and it was a sunny day. I think it may have been cloudy in Washington State. It was probably cloudy.
Probably
And
raining up there.
it was probably raining. It was probably storming, thundering, and everything. And I was just like, Benjamin, I'm tired of silver. I'm done with this trade. I don't think it's going anywhere. I've been in it for a long time. And just to clarify, I'm talking about silver equities. I still got silver ounces. I still got a lot of silver ounces. So, I still believe in the physical of silver. But the equities, I just got shooken out. I told Rick that too. I was like, hey, I'm done with silver, man. I'm done with it. And then we saw a big move that I missed out on. So, yeah, what did I miss out on, Ben?
I think you're perhaps a little bit unlucky. First of all, I want to say I've done this plenty of times myself. I think we all have, so don't beat yourself up too much. I think that you can borrow a thesis, you can borrow ideas, but you can't borrow conviction and understanding of those ideas. So one thing that we need to understand is that there is a hell of a lot of volatility. And if we're talking about particularly the metals and precious metals, even more so, you're going to go through long periods of disappointment. And so, how do you decide how you're going to profit from that? And how I like to do it, similar to you, I have some physical, but I like to either look for an inflection point if I'm going to really go out into some of those companies with talk, or there's another way that I think just people just ignore and they shouldn't ignore, and that is to stick with royalty and streaming companies where they can outperform during periods of sideways or even declining commodity prices. And that's due to the structure of the business model themselves. So if you were looking for asymmetric upside, which we probably were when we were having that chat, maybe you just needed to wait that little bit longer, have an understanding about the supply and the demand. And if you keep revisiting your thesis and saying, well, everything that all the reasons that I had to invest in the first place are still relevant, then the rest is patience. I
Yeah.
think I don't think anything's changed really in the thesis since we spoke in December last year. All that's changed is the pricing. And I guess to illustrate my point here, guys, what if you allow me to share the screen? Here we've got year to date. Okay, so right after where you and I last spoke, you mentioned silver. I've got silver here, the metal at the top, and then I've got the equities as represented by the sector ETF. So
Mhm.
they've outshone. Uranium, which is where all the hot money was when we spoke, has actually declined a little bit. That doesn't say anything about the long-term thesis about uranium, by the way. I just thought that there was too much momentum at the time. And we've got wheat and precious metals here, which in a rising price environment has slightly underperformed the equities and the commodity itself. But if you start to go out over time, you'll find that Wheaton holds its own or outperforms. So I've taken the liberty to share with you an article that I wrote in March, before all this really started to take off. And it's this chart here that I want to leave you guys with. This is looking at metals, precious metals, gold in this case, and it's comparing the commodity itself, a producer, in other words, a miner, and a royalty company. Now, please bear in mind, this does not apply for oil during periods of inflation. That is a little different. However, in the case of silver or precious metals, royalty companies from 2007 to today have, as you can see, completely outperformed not just the producers, but also the commodity itself. And you say, well, why is that? And that is because the royalties can continue to make profits at good margins in declining and sideways price environments. So if you're like we were getting a little bit frustrated with the commodity silver, the silver miners. There's another way to play it, which is through a royalty and a streaming company. The silver price obviously has increased over that time period, but it wasn't a massive bull market by any means. And so that's one thing that I really wanted to touch on. I think that perhaps if you're setting up if you're setting up your portfolio and you're looking at getting exposure to, in this case, we're talking about silver or metals, but you're just not able to tolerate some of that volatility, there is absolutely nothing wrong with going with a royalty company. And again, in this chart here, what I'd like to point out is the difference between the producers of gold and silver down the bottom here, as measured by GDX and the SIL, versus the two, I guess, best known royalty and streaming companies, which Franco-Nevada and Wheaton Precious Metals. So over that similar time period where the commodities did okay, not that great over an annualized basis, and as you can see here, the miners actually went backwards, so you lost money. These guys here, the royalties and the streamers, were multi-baggers in a decade or a little bit longer than a decade where you really didn't have strong price performance. So in reframing your question, I would say you probably didn't miss anything. You may simply have been misplaced in either the way you were positioned or your expectations.
Yeah, for sure. That was very eloquent in how you said that. So I want to look at a couple things. So when I was looking at the price of some of the silver equities, and here I'm just looking at a chart of Pan American,
Mhm.
and like when Rick talks about the silver squeeze, right? We had the silver squeeze 2020 to 2021, where this stock, shot up from $10 to, close to $40, right? And then we see it come back down, to, somewhere around $11, $12. And now it's sitting at 19. So like that's the move I mean, you do see the candles here,
Mhm.
the three big candles, but it still hasn't even got back to like its previous, highs. And silver crossed $30, which it hasn't even crossed $30 in a long time. And so it was kind of just because I'm thinking of it in terms of like it depends on when you get in, right? So if you got in
Certainly.
and you're continuously buying and then the price keeps falling, and then you're like, okay, for example, this big candle here, I was buying Pan American somewhere within here. It was like $18. Drop, you buy some more. Then it keeps dropping, you buy some more. Then it drops more. And then you're like, okay, do I just like am I just in a bad trade right now? Did I just get in at the
Mhm.
wrong time? And then, when you get out, you see the moves up, right? It's like it's almost like some reverse psychology or something that the market plays with you. Oh, so yeah, what did you what advice or what strategies would you give people in that type of situation? Time out. Quick break in the action. This message is brought to you by the Rule Symposium. This annual symposium is hosted by the legendary investor Rick Rule himself. It will take place from July 7th through 11th in Boca Raton, Florida. Mr. Rule invites some of the most brilliant minds in macroeconomics and natural resource investing. This year, featured speakers include Danielle DiMartino Booth, Nomi Prinz, Jim Rickards, Grant Williams, Lobo Tigre, and more. Rick even organizes the Living Legends panel where he invites individuals who have built billion-dollar businesses from scratch. Attendees will be introduced to a myriad of companies active in the natural resources space, with the companies invited being the ones that Rick Rule invests in himself. The symposium is held at the Boca Raton, which is an amazing resort with exceptional amenities. I attended in 2023 and thoroughly enjoyed my time there. I went on an amazing cruise with Rick and other investors and CEOs of companies, and even had the opportunity to test drive an Aston Martin for the first time. So don't miss out on this opportunity to have fun and receive high quality education to help secure your financial future. Click the link below to sign up, and I promise you won't regret it. But if you do, Rick offers an amazing money back guarantee. So what are you waiting for? Click the link below to sign up today. Now, without further ado, let's get back to the content.
Certainly. So that's a very, very, very common thing. There are two main points that I'd like to address. The first is, again, coming back to that conviction. Before entering in a trade, did you go through, look at the company and have a good estimation? It's not going to be perfect, but do you have a good understanding of its production levels, what kind of margin it can reasonably achieve at what particular commodity price? And you need to do that. You need to have a back of the envelope calculation to give you a good understanding of the intrinsic value. And so if you had a really good intrinsic value estimate because you did your homework and you said, for argument's sake, okay, you thought it was $30. When that price started to decline, when you went back to check your facts, if they still were telling you that you had an intrinsic value of, just for example, $30, I think that would have been easier for you to have held on to the stock. So the first point would be know what you own and have a good understanding of a valuation. It doesn't have to be perfect, but you've got to have a ballpark figure in your mind and write that down because you're going to forget. Okay. So in your list of investments, you might have, in this case, Pan American, estimate of intrinsic value as of January 2024 at X dollars, $30, purely and simply for argument's sake. I think that is going to help you over the longer term. The next part is the execution of how you enter and how you exit your investment. So what I like to do is to have an understanding of the intrinsic value and say, okay, I think this opportunity deserves a 3, 4, 5% weighting in my portfolio. Whatever that is for you, it's going to be different for everyone. And you need to decide, look, I think 3 to 5% of my portfolio, I'd be very happy putting into this company. Wonderful. When the company is trading at $19, as you mentioned, you might allocate 1%. Then as the company continues to drop, you revisit your thesis and you say, actually, no, nothing has changed. I still believe in the $30 valuation. I'm going to add in another tranche or layer of 1%. And as you continue to do that, you lower your average entry price. So the difference between $19 to the bottom there of around 12, 12 and a half is very painful. And what I do, I have a couple of rules, which one of which is that if I enter an investment and I see the price decline at 25 to 30% decline, I've got to make a decision. I have to cut the investment or I have to buy more to lower my entry cost. And that forces me to revisit my thesis, and it forces me to either cut the investment or to increase my position at a much more desirable entry price. It's simple. You can have your own tweak on it, but it really does work, and it really will improve your trading and your investing over time. So in summary, strong understanding of intrinsic value and rules as to position sizing and how you're going to allocate your investment in the event of a decline in price.
Gotcha. Yep. Yep. That's really good. And
Yeah.
so with
Because
that,
let me ask you this, and sorry to interrupt, but let me ask you this. From 19 to 12 and a half, that was a very uncomfortable drop. But what if you had have allocated such that your average entry in this example was more like 14 or $13? The drop from 14 or $13 to 12, 12 and a half, I think you would have been able to tolerate that. And so I think those two tools for next time will allow you to either cut the investment and say, okay, this change of thesis, no problems, or lower that average entry cost and say, I can tolerate being underwater maybe 8, 9, 10% of my position. But when you start to get from 19 towards 12, I mean, you're getting fairly close to 40% drop, and it's much more painful psychologically.
Yeah, yeah, yeah. That makes total sense. So how do you? So let's say, for example, you have a macro thesis, right? Okay, we know that precious metals, how it moves, when it moves, historical moves and such. And so then let's say an investor wants to get into the big names, the Newmonts, the Barricks and everything. So uh I'm gonna share screen really quick. So I saw this in particular um when it was happening, and ever since I've been watching Newmont, right? I saw Newmont at when it hit $80, over $80 here. Even after the pandemic, it ran from 40, up to $70. And then early this year, I was looking at Newmont when it hit $29. And it's like, okay, I haven't seen Newmont at this price since I've even been engaging with the stock. So you as an investor, when you see that type of price move for even just a big, huge company like Newmont, not saying that, you believe Newmont's a good company, but do you feel that that warrants like looking into?
Well, certainly if that's, and obviously it's different for every investor, but if you were, as you say, you had a thesis and you were looking for exposure in a given sector, um, you would start with the highest quality, presumably, or the highest exposure. And that would certainly suggest to me that I should start to take a look. And then if you were to overlay that with the gold price, and there's a few different ways you can do it, you can simply compare the price percentage in terms of gold price action versus Newmont stock price action, similar to what I shared previously. Or you could divide Newmont by the gold price and see relatively, is gold expensive relative to Newmont, or is Newmont relatively expensive to gold? And there are a few different ways that you can then start to go, but absolutely, you can use price as a trigger and to take a look. The only issue is it doesn't tell you anything else around the operations of the company.
Hmm. Yeah, 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 definitely. And and I think that my, I guess, bias, which this isn't the right way to go about it, is like during the pandemic when we had that big drop in a lot of companies, right? I mean, for example, Diamondback Energy.
Good example.
Diamondback Energy. I didn't even know what I was holding, right? It just, I was just like, hey, I never really invested in stocks before, but this looks like a very cheap company compared to its former price. And I didn't know what was happening with oil and obviously the economy being shut down and everything, right? So, it goes from, $140 and, you see it drop, but, it's at about $100 going into the pandemic. It goes all the way down to $14. So I was buying Diamondback at $14. I sold it when it started to pop. I didn't not knowing, anything about the oil markets or anything like that. That came like later. And so sometimes like I think that there's like these situations that may occur where something is just way too I guess cheap, or there's a lot of fear in the market to
Hmm.
where people oversell stocks. Obviously, I didn't know where Diamondback Energy were going. I didn't have, any information on the company or anything. I was just looking at simply like, hey, this thing has declined this amount, everybody's selling their shares. Let me just go in and buy it. Right.
Yeah,
And so,
price sentiment trading. Yeah.
mhm. So is that a obviously that can bite you in the ass too, right? You know what I'm saying? So so like
Indeed, as we found out with the Pan American example, which
yeah,
is
yeah.
which is the opposite of this example. Yeah.
Yeah, yeah. So do you I mean, I know that you got into like the trading and investing, around that same time. Like now with the knowledge that you have, how would you like if we were to see like big drawdowns like that, would you take the time to actually look at the company and see that, or would you, like based on the price of it, like pull?
No, I would not invest based on price alone, because you're not investing, you're trading, speculating, which is fine. Like some people can do that. That's great. But what would have happened? Who knows? If Diamondback was a good example, but there are some companies that didn't make it. So if you were just looking at offshore oil prices, for instance, you may have done the same thing and ended up holding shares of a company that filed for bankruptcy,
Mhm.
which, unless you were holding Transocean stock, that is exactly what happened to all of them. So you do. I certainly understand what you're saying. I think you can definitely use price as a trigger to take a look at something and say, is it is it justified or not, this price movement up or down? But once again, the only reliable way over time is to have an understanding of price and value. And so, okay, we can have a look at the price. That's easy. We still need to have an understanding of the value. And because just because something drops by 90% doesn't mean that it's cheap. The value of the business may have dropped by 95%.
Mhm.
And those are some points that I would like to bring up because I personally would not feel comfortable having learnt some of those same lessons the hard way. I think there is no way around having an understanding of valuation.
Yeah, 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 definitely. Yeah, that's good. Appreciate that. So you've been talking about iron ore,
Yes, sir.
and a lot of people's talking about copper. Many people aren't talking about iron ore. What is your thesis there that that is causing you to be more optimistic and bullish on iron ore?
Kind of almost the inverse of what I just said, which is the price. However, to your point, let me share my screen. I wrote about this in my most recent article. I think the fundamentals for the industry are based around the electrification of things that will obviously require copper. So everyone understands that. What people don't apparently understand is that iron ore tracks copper relatively closely. There's decent correlation between the two. So I looked at copper earlier this year and I felt like I didn't understand the companies well enough to come up with that valuation. And so I decided to do another option, which we haven't mentioned, which is to simply do nothing. And so in this case, I watched copper go up and up and up, and I did not participate, but I also did not lose any money. Instead, I look 6 months down the track and I see the blue line here, which is an iron ore index, versus the orange line here, which is a copper index. And as you can see, there's quite a decent amount of correlation. This gave me the indication to take a look. I didn't just start buying iron ore because I thought it was cheap. It gave me a good, I suppose, stimulus to for further investigation. And what do I know about iron ore and copper? They're both industrial metals. So I would expect an increase in stimulatory packages from Western governments to try and stimulate the economy is going to require roads and infrastructure building and electrification and some green energy and all that sort of stuff. So copper will certainly be more in demand, and we know the supply story is very challenged around copper. And so iron ore has not taken part in that rally as of yet, but I would expect that gap to close. So that's my reasoning for pointing out, hey guys, maybe we should look at iron ore because no one else is. And so then I would start to look into companies with exposure to iron ore. And as the way the mining in this industry works, they almost always have exposure to copper anyway. And then coming full circle to what we mentioned at the start of the discussion today, I just looked at something that was simple and easy to understand, which is a company that is a royalty company on iron ore production. I thought it's very cheap, it's very easy for me to value. And if iron ore doesn't move in price, I still make a lot of money based on this company's business model.
Mhm.
Hopefully that answers your question.
Yeah, yeah, yeah. So with royalty and streaming, which I've interviewed someone from Sandstorm Gold, and just like it is a simple way to invest in like metals because they do the valuations, they do the um, whether to finance a project or not. You can just really simply look at their cash flows, how are they benefiting from the mining, what price per ounce they're getting, and such, and
Indeed.
so and what type of percentage are they getting on the royalty, right?
Exactly.
So it's definitely a simpler way to engage, but and then you showed the charts of Franco Nevada and Wheaton Precious Metals, where gold and silver were just, I mean, they were getting plummet. They were plummeting in 2015 to 2018, and these royalty and streaming companies are getting, going up in price, and so I definitely see the case for them, and it's definitely a more simplistic way for investors that don't want to get into the weeds of a lot of these commodities.
Absolutely. There's no requirement for you to take any extra risk than you have to. It's just our inner cowboy comes out in us and we think we're going to get a 10 to 1 shot. But let me ask you this. Would you I mean, would you be happy if I offered you access to the same thesis really with companies proven to compound in their value over time at 18, 19, 20% year on year? I mean, think about this. If you had a bank account that you could put money into and it gave you compounded returns, 18, 19, 20%. I mean, you're doubling your money every 3 to 4 years and you're getting almost all the upside and almost none of the downside. Um, Sometimes it pays to take a step back and and just consider going to the beach for 3 or 4 years while your money doubles.
Hmm. Yeah, for sure. Yeah, definitely. And so whenever you engage with like royalty and streaming, so there's a time where price, either moves ahead of itself or whatnot. So, when you say that you have to have a number, that's very, very important, in terms of like, you got to know when to sell, right? You,
Yeah.
you got to know, hey, is this getting ahead of itself or what? So I'm just going to share screen again. So when I was in New Orleans back in November, the this is Franco, Nevada. I remember being there. So it was in November of last year. So that was what, around this time. And this was around the time the news about, I think it was Panama.
Yeah.
They had like a strike or something like that. And so then you just begin to see, it decline significantly, to $104. And then now it's popped up a little bit. Um, So when looking at this in terms of like, okay, you having a number for what you think the value should be, right? Because at some point, like, I mean, I've seen this with the uranium equities where I
Yeah.
can position myself long term, but then like I'm seeing some of these companies fall back like close to, not significantly close to like my cost per share, but because I got in like a lot earlier on some of the companies, but like if you keep buying, then you're increasing your cost per share, and then you're seeing these companies come down significantly. And so just trying to find like, okay, because I've heard like Rick, even with the uranium equities, there's times where he said, hey, they're getting ahead of themselves. I'm going to trim my positions, take some profits, and knowing like when it's going to come back down. I think sometimes the thesis can outweigh, at least for me, sometimes the long-term thesis can outweigh like the short-term like price movements, in terms of like, okay, I should have took some dang profits on some of these,
Mhm.
right? And so how do you manage that as an investor?
It's the same answer. It's the same answer, mate. Going through, and in the case of uranium, which you mentioned, I'm not sure if you caught a discussion that Chapman and we went through this very, very same question when uranium equities were roaring, and we worked out that some were discounting in like three, four, $500 a pound uranium, and so that quite obviously didn't make sense in the price environment. It comes back to having a valuation model of saying this company can produce X amount of commodity or X amount of shoes. It doesn't matter. Their production can be X, their margins are going to be Y. This is what I have a reasonable base case of this company, and I think it's worth, for instance, $5, plucking a number out of the air. When everyone gets excited and the company goes to $6 or $7 a share, I think that you revisit your thesis and you say, well, this company is just producing, in this case, uranium. Uranium price is at $100, 110, and it's the valuation that the market's putting on this thing is trading for like $400 or $500 uranium. I don't think that's going to happen. I'm going to take my money. And you need to
Mhm.
do those kinds of calculations. Once again, if you have that ability to have a rough idea of production, margin, and at what price or what cost of the commodity, that will really guide you into saying, do I think the uranium price is going to go 4x in the next year? Maybe, but probably not. So I'm going to take my money off the table. And it doesn't mean that you sell at $6 and it keeps going to 7, 8, 9, 10. I mean, look at Nvidia. That's a good example. But
Yeah,
if you
yeah,
don't have those guidelines, you completely lost.
yeah, 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 yeah. Because I've been seeing like, because some of the sentiment around it, right?
Mhm.
Hey, you get all of this bullish news, right? And then you look at former, price performance of the commodity. I
Mhm.
mean, you look at, some of these stocks, just going up 10, 20x, in the last bull market. And you're
Mhm.
like, okay, have we, not you per se, but just like what I've seen, and even myself, like I've struggled with this. And okay, are we even here yet? Um, like are we going a lot more higher, based on like, okay, because I can look at like supply and demand of uranium. I can look at how many nuclear reactors are being built, the clean energy goals for which this is more of a macro thesis, right? um, Clean energy goals of nations, the advancement of AI, and the energy intensiveness that it has, and looking at Microsoft, Google, and all of them investing in nuclear power. And so, you know, and then it like, what happens though, like for me personally, it's like, okay, is this gonna go a lot higher? And I guess it depends on time horizons, right? I mean, because some
Does.
people can buy and like, hey, I'm just gonna hold for however long until I see this thesis play out. If I expect that there's going to be a parabolic move, some people trade in the intermediate term time frame. So, like Rick, he's like, hey, I'm taking profits off the table, and then rinse and repeat,
Mhm.
right? And I think those people are more savvy, with it, and
Uh, Definitely. In the case of Uncle Rick, he will always have a base metric with different commodity prices, and that's how he gets his understanding of whether he thinks this is more expensive than it should be or cheaper than it should be.
hmm yeah, yeah, that's true. So yeah, yeah, appreciate you sharing that, because that's very helpful in terms of me just wrapping my head around um, these commodities. So
Yeah, they're,
what?
they're not easy. They're not easy, Daryl, because it's always a moving target. All the cash flows are going to depend on the price of what these things sell, and that's not static. So it's tricky.
Yeah, yeah, for sure, for sure. So what is your so like you mentioned early, I don't know if we were off camera or on camera, but you had mentioned that the investment in infrastructure. Obviously, we talk about the capex and oil companies and such, which is a longer term, you know, uh, thing that we're starting to see. I mean, you and I, like, we've probably been interviewing each other for like what, a year or something,
That's
almost
what
going
I'm
on a
thinking.
year. Like, so a
Mhm.
year has passed, and like we
Mhm.
still haven't seen what we're expecting and what needs to happen for, because we see, government, so like you get this long term thing again, right?
Mhm.
Um, and so how do you in terms of like right now, for example, you're looking at I think we talked a little bit, but we talked about offshore oil.
Certainly.
Um, so how would you factor that into like your long-term thesis? Like do you buy cheap, sell obviously, I mean you sell high, or are you trading within the range? Are you covered calls, right? Are,
The answer is yeah. So all the above, and we may have mentioned this before. I certainly mentioned it with Uncle Rick a couple of days ago, where I'm very clear as to what I want to achieve. And so if I'm trading for options and income, it's in a separate portfolio. And the
mhm,
longer term investment is in a separate portfolio. Just mentally, it helps me separate the two, and it helps me separate my time horizons. So I'm doing both by two different strategies. And in terms of long term investment, we have, and everyone except the governments apparently know that we have underinvested in capex for oil production. Oil is different to all the other commodities because it is required for the refined products are required for transport. You cannot put coal in your automobile. Okay, like the
mhm,
old steam train engines, they're fun for tourism, but it ain't going to get the job done. Solar panels are great, but they are not going to power your car. Uranium, fantastic, but you're not going to have like a mini reactor in your car just yet. Probably in 100 years, who knows? It would be really
mhm,
cool. So there is only one way you're going to get these refined products, and that's going to require crude oil, and that's going to require sources of crude oil. So then you've got onshore and you've got offshore. Onshore hasn't been the development, geopolitics getting more and more tricky, and a lot of these wells are drying up, rolling over, and or in the case of shale, which is what the world really relies on for the swing production, is getting more and more gassy. Why is that important? Because again, gas cannot really be refined into diesel or kerosene or jet fuel. So offshore, we have lots of promising wells and reserves out there. This will need a lot of capex. This will need the oil price or contracts for the oil to be signed at certain prices that make sense. Because if you imagine drilling underneath meters and meters of ocean, you've got to run pipes for these things. You're going to need vessels to operate. All this stuff is going to take a lot of capex. So this is a longer term trend that I can look at and say there's going to be a lot of demand for this thing. The break evens are comparable to onshore in many onshore wells, and we have longer life in the offshore space. So this gives me a really good. The argument against offshore is no longer valid. It's no longer valid to say it costs so much more than onshore. It's getting closer and closer the more that we start to tap these onshore wells. Right at the time where all these companies, except for Transocean, have just gone bankrupt. So the other argument that they're indebted and they're sensitive to an oil price drop is no longer valid. And having drained the SPR, our sources of supply are dwindling and dwindling and dwindling and dwindling. What makes more sense to try and squeeze more and more juice out of shale, which is struggling to provide the liquid content, as I understand it, or to really engage in certain areas around the world, Guyana, Namibia, offshore Brazil, to sign longer term contracts where the oil service companies know what they're going to get, the governments, the Chevrons, the Exxons of the world know what they're going to get, and I can have access to a steady stream of capital inflows over 7, 8, 9, 10 years.
mhm. Gotcha. Gotcha. That makes sense. So a couple questions before we get off. Um, Compounding.
Mm.
So you have the dividends that many of these companies pay. So how do you treat compounding in your investment strategy? And then I also want to know, um, do you factor in technical analysis as well? Like, so you get a valuation, you get a number. Some people look at charts, right? And so when you have, commodities like silver, rising above, breaking above $30, and then you have to go back to what 2011 to even get any technical lines for what happens next there. Um, Same thing with other assets, right? Because some other assets, like you don't have a technical analysis of like where it's at because it's broken above like previous all-time highs and stuff. And so like when you get to that point, how do you factor that into your how do you factor that into the equation as well, or do you consider it at all?
So yes, I consider it. That would be more appropriate in terms of where I'm going to place income trades or entry trades. So for instance, if you were to use a MACD, so 14-day momentum calculator, or if you were to use the RSI, which is another common one, if I see that the RSI is really bottoming out around 30 or below 30, that suggests that there's a lot of selling momentum. And so that might be, if I have a strong thesis around the company, that would suggest a good entry point. Why? Because there's a lot of selling pressure. And as Seth Klarman would say, you make your money on the way down because that's where the liquidity is. People want to sell the stock, sometimes for positive reasons. So this week we saw Tidewater, a lot of their directors and large owners selling a lot of shares. And do we worry about that? Is that a good thing? Is it a bad thing? In this case, these guys bought a ton of shares. They had a ton of shares at very, very low prices. So they've made an absolute bundle and they're just taking some profits for who knows why. Maybe they want to buy a new house, a new car, whatever the case may be. So in terms of entry, I might look at it in terms of my income strategy. I might look to sell some options based on where it's at on the RSI. But over the longer term, I would look at it to either enter or to take a little bit of profit because just as I average my entries, I want to average my exits to capture as much of the upside as I can. But once again, that will all be compared relative to my idea of the valuation.
Yeah, gotcha. Okay, and then compounding. Um,
Compounding, oh boy, that's so hard. Why? Just because you got to be patient for the damn thing. Because I mean, it's the biggest frustration is interrupting compounding. And I've done it. Everyone's done this. And you look back and you're like, God damn it, if I just had have held on to this thing, it would have performed extremely well. And even if you do well, when you compare, if you had have left it, a lot of the times you would have been better off. So not interrupting compounding is obviously a huge, huge deal. And I think that's where exiting in tranches is a really good strategy of execution because it limits your risk of interrupting your own compounding. So that would be, again, a case for exiting in tranches. Compounding helps a lot when you don't really have to worry about the downside and you know the business in and out. So again, royalties, and they've got almost 100% operating margins. So it makes it a lot easier for me to just simply sit in this thing and say, okay, well, if the price of the commodity drops, so what? I get a 8% dividend instead of a 10% dividend this year. And then to your point about compounding, if you compare reinvesting dividends versus not, you'll see the case for compounding over time because you'll eventually, once you hit that escape velocity, your investments will outperform, but you have to give that time.
yeah, for sure. Yeah, the compounding take forever, man. Like every
And
three
then
months,
until it doesn't.
every quarter. You
Yeah,
know,
yeah, yeah.
I'm looking forward to this to this Echo Patrol um dividend. So I don't know. I've been looking at the company more and just trying to see what's happening there.
I
Um,
just took out some of my last remaining shares.
mm,
Speaking of Ecopetrol, yeah, it's been a good
yeah,
ride. Been a very good
yeah.
ride.
It is. I feel like you know, just looking at the amount of dividends they're paying out, I'm just like, okay, is this even sustainable? Like even right now at today's, you know, oil prices, because Petrobras, like they were paying out what a huge amount like a year or so ago.
They were at around 60% payout ratio, and they cut it back to 40. I think that I think that they'd still be quite sustainable. But this would be a case in point as I've got a decision to make. So I had made more than 100%. What do I do? I thought that there were better opportunities elsewhere, much more simple and easy to understand. So I took out my initial capital. I left my gains on the table to compound. And so I don't have to worry quite so much as to what happens there. But in terms of Petrobras, would I re-enter with the same weighting today? It's not the same company and it's not as cheap. So I probably wouldn't.
Yeah, yeah. These things move fast, and I mean, even how you mentioned, because we talked about, where you're investing in terms of oil, and you mentioned the oil services, and
Yeah.
I think you
These are
mentioned.
ones that you can't own forever. So it's a good point. If you bring up compounding, that's a great point. Cyclicals, you will try and hold them. What you'll find is that they will interrupt your compounding because they will go through like significant down markets. So in general, royalties aside, these are not long-term holds. They cannot be because you'll experience the inevitable down markets, and those producers are simply tied to those commodity prices. So uh, you you simply cannot treat this as a long-term buy and hold outside of the royalty codes for that reason. So I think that's a good point to bring up.
Yeah, yeah, gotcha. So, Ben, appreciate this investing masterclass that you all got for free. Um, y'all need to be sure to go check out his Substack newsletter, link in the description. And I just want to recap. So you got to have a number where you think the company is going to go, and you have to do valuation models or whatnot to figure out the number. Then you want to figure out your entry point, which you can look at MACD or the relative strength index in terms of, and then you mentioned below 30 shows a lot of selling pressure, and that could be a point that you may want to enter. And then in terms of compounding, cyclicals you can't hold forever, and necessarily you shouldn't hold forever. You can, but you
I
you
don't
may get
advise it.
you may get wrecked.
Yeah.
So and that comes back to like having that number in mind of like, okay, where you think this company should be. Um, and you have to be careful of interrupting your compound, but another strategy you could use is taking some profits off the table, taking your initial investment off the table, and allowing the gains to compound. And then you also mentioned like having a strategy for like if you when you have that number and you see the stock price dropping, you can buy in a tranche, initial tranche. Then say it drops more, you still have that same thesis, that same valuation in mind. I'm surprised I'm remembering all this, by the way.
Yeah, you did.
and then and then you can buy another tranche or whatnot. And then as you sell, as the price goes up, towards that number that you have in mind, that thesis, you start to sell in tranches. So you can begin to take some of that initial investment and that capital back off the table.
Exactly. Very, very good summary, sir.
All right, y'all. Investor class with my guy Ben. Y'all be sure to go check out his channel. I'll link to it in the description, also in the title of this, as well as check out his newsletter. Actually, let's share. So you shared some of your articles from the newsletter. Could
Yes.
you talk a little more about it?
Sure, absolutely. So I've amalgamated all my publications, my written publications, into the ROI Club. In this club, you'll get access to a lot of what we spoke about today. So I break down my process for coming up with a valuation that we spoke about. So there's a lot of material in there that's for free. Stock specific stuff is behind paywalls. And that would be, I guess, the most popular part of the publication. There's also the Maverick Life section, where I break down a lot of the income generation strategies that I use, so that if I want to travel overseas for an extended period and continue to earn income, I share some of the exact trades that I'm doing. So in that section, I don't give you theory. I give you exactly what I'm doing, with screenshots of my brokerage account. There's a portfolio there that I've set aside. And so I update every time there's new trading activity, and I give you a screenshot as to how that's performing. So I give you my research in the ROI Club, and in the Maverick Life, I literally give you trades that I do combined with real-time performance update. It's no theory, it's just exactly over the shoulder look at me living the Maverick life.
All right, sounds good. Sounds good. Living a Maverick life. So you all be sure to go check that out. Thanks for coming back on, Ben.
My
I look
pleasure.
forward to seeing you virtually on the Real Symposium. You may see me in the background somewhere or something, but I'm glad you're gonna be there.
I'll be looking forward to it, and I'll be looking for you in the background.
All right, all right. We may have to go live at the symposium. I was thinking we need to get more live. I need to get more live content this year.
We could do that. Yeah, sounds great.
All right, all right. We'll talk soon.